Welcome to The Explainer. Today we're diving into a book that's basically the Bible for smart investing, Benjamin Graham's The Intelligent Investor. It is a classic for a very good reason, and it has shaped some of the greatest financial minds out there.
And hey, you don't have to take my word for it. Just listen to this from Warren Buffett himself. He literally says Graham was the second most influential person in his entire life, right behind his own dad. I mean, that's a huge deal. So what is it about this book that's so powerful?
Well, what problem was Graham even trying to solve? Think about Wall Street. It can feel like a total circus, right? More like a giant casino than a place for logical decisions. Graham wanted to bring some order to that chaos. And to really get why that's so crucial, we've got to look back in time a bit.
Let's talk about Sir Isaac Newton. And yeah, I mean the Sir Isaac Newton. Calculus, gravity, the whole 9 yards. An undisputed genius. And he got completely wrecked by market mania. It really makes you think. If one of the smartest people in all of history can lose his shirt, what chance do the rest of us really have?
So Newton said this right after he'd actually made a super smart move. He got into the South Sea Company, which was kind of like the meme stock of its day, and he sold his shares for 100% profit, doubled his money. He saw the writing on the wall, saw the bubble, and cashed out. Pretty brilliant, you'd think.
But then, FOMO kicked in. Big time. Just a few months later, he's watching his friends get even richer, and he just can't stand it. The hype was just too much. So he let all that noise from the crowd drown out his own brilliant judgment. He jumped back into the market at a way higher price and lost a fortune. We're talking the equivalent of over $3 million today. Ouch.
Okay, so this is exactly the kind of disaster Graham wants to help us avoid. And he says the very first step is to understand the huge, fundamental difference between investing and speculating. They are not the same thing, not even close.
And Graham gives us a really specific 3-part definition. He says for something to be a real investment operation, it has to meet 3 criteria. First, you've done your homework, thorough analysis. Second, it promises safety of principal, meaning you're not likely to lose your initial investment. And third, you're looking for an adequate return. Notice he says adequate, not get rich overnight. If it doesn't meet all 3 of those, then Graham says it's just speculation, period.
So here's the bottom line, the real key difference. An investor looks at a business and decides what it's worth. Then they look at the stock price. A speculator looks at the stock price and tries to guess where it's going next. See the difference? An investor's thinking is rooted in business value. A speculator's thinking is rooted in market sentiment.
But here's a twist. Graham argues that what really separates an investor from a speculator, it's not how smart you are, it's not your IQ, it's something much deeper.
You know, you don't need to be a rocket scientist like Isaac Newton to be a great investor. What you do need, what's absolutely crucial, is a trait of character, emotional discipline. It's all about having the ability to stop yourself from doing the self-defeating things that most people do in the market out of fear or greed.
And this is one of Graham's most famous lines for a reason. He's basically saying that the biggest danger in investing isn't a market crash or a bad economy. It's you. It's us. Our own emotions are always there, whispering in our ear, tempting us to throw our rational plan out the window and just follow the herd, just like Newton did.
So if we're the biggest problem, how the heck do we protect ourselves from ourselves, right? Well, this is where Graham gives us some amazing tools. And of all the wisdom in his book, Warren Buffett says there are 2 ideas that stand head and shoulders above the rest. They're the absolute foundation.
Okay, rule number 1 is all about how to think about the wild swings of the market. And Graham gives us this incredible mental model. He says, imagine the stock market isn't some faceless thing. Imagine it's a person. He's your business partner, and his name is Mr. Market. Every single day, this guy shows up and offers to either buy your shares or sell you his. The catch? He's totally manic-depressive. Some days he's euphoric, offering you insane prices. Other days he's deeply depressed and willing to sell you his shares for pennies on the dollar. But here's the secret. You're completely free to just ignore him. His mood is your opportunity, not your guide. And this isn't just some abstract idea. You can see Mr. Market's mood swings in the data. Look at this. Back in 1948, Mr. Market was super depressed. Investors would only pay about 9 times a company's earnings. But fast forward to 1968, and he's totally euphoric. Now he's willing to pay almost 20 times earnings, more than double, for the exact same earning power. The intelligent investor's job is simple. Take advantage of these mood swings.
You buy from Mr. Market when he's pessimistic, and you sell to him when he's ecstatic. All right, that brings us to Graham's second golden rule. And if Mr. Market is the foundation, this next concept is the entire skyscraper built on top of it. Graham himself called it the central concept of investment. This is the big one, folks, the margin of safety.
And it's so beautifully simple. It's just 2 steps. Step 1, you do the work. You analyze the business, its assets, its earnings, its prospects, and you calculate its intrinsic value. You figure out what it's really worth. Then comes step 2, the most important part. You only buy it when it's trading for a significant discount to that value. You insist on buying it on sale. That gap, that discount between the real value and the price you pay, that is your margin of safety. It's the cushion that protects you when you're wrong, when you have bad luck, or when Mr. Market has another one of his fits.
So let's pull all this together. What's the ultimate point of all this? Well, it's really important to understand that Graham's book is not a guide to getting rich quick. He's not giving you hot stock tips.
What he's giving you is something so much more valuable. He's giving you a solid, intellectual framework for making decisions. Think of it like an operating system for your investment brain. And its main job isn't to make you a genius, it's to stop you from acting like a fool. It's all about having the discipline to not let your emotions come in and wreck the whole thing.
And why does that matter so much? Because at the end of the day, the goal here is to profit from the foolishness you see in the market, not to join in on it. What Graham's principles really give you is the discipline, and frankly, the courage, to take control of your own financial destiny, to stop being a puppet pulled by the strings of Mr. Market's moods.
And that brings us right back to Graham's most powerful insight. See, the ultimate lesson here isn't a stock tip, it's a mirror. It's about looking at your own behavior and asking, am I making my decisions based on the value of a business, or am I just getting swept away by the madness of the crowd? In the end, mastering the market really does begin and end with mastering yourself.